Here's a question that trips up almost every new investor. Two stocks. One trades at $10 a share, the other at $500. Which company is bigger? If you said the $500 one, you just fell for the most common misconception in the entire stock market. Because the honest answer is, you can't tell. Not from the price. What you need is a number called market cap. And once it clicks, the whole market starts to make sense. Market cap, short for market capitalization, is the total value of all a company's shares added together. The math is simple. Take the share price, multiply it by the number of shares the company has outstanding. Price times share count. That's the whole thing. Think of a company as a pizza. The share price is what one slice costs. But how many slices the pizza gets cut into is up to the company. Some cut it into a handful of big pieces, others into millions of tiny ones. Market cap is the size of the whole pizza. And that's what breaks the misconception. A cheap slice can come off an enormous pie. Picture two companies. Both trade at $50 a share. The first has 5 million shares outstanding. Multiply it out, and the company is worth $250 million. The second has 5 billion shares. Same $50 price. But that company is worth $250 billion. One is a small business. The other is a giant. Identical share price. 1,000 times the size. That's how a $10 stock can tower over a $500 one. If the $10 company has 10 billion shares and the $500 company has 10 million, the cheap-looking stock is the far bigger business. The price is just the sticker on a single share. It tells you nothing about how many shares stand behind it. Want proof the price is almost arbitrary? Companies split their stock all the time. A business can split one share worth $100 into two worth $50 overnight. Nothing real changed. Same company, same value. They just sliced the pizza thinner. The price dropped by half. The market cap didn't move an inch. The price is a decision. The cap is the reality. This is why investors sort companies by market cap, never by price. At the very top sit the mega caps, the household names worth hundreds of billions, the ones that first crossed $1 trillion in value. Below them, the large caps, generally $10 billion and up, established and steady. Then the mid caps, still growing into their potential. And down at the base, the small caps and micro caps, younger, riskier, with the most room to soar and the most room to crash. The bucket a company falls into tells you more about its risk and its stage of life than its share price ever will. But market cap has limits, and they matter. It only measures the equity, the stock. It ignores debt, so a company buried in loans can still flash a big market cap. For the fuller picture, investors reach for something called enterprise value. And here's the deeper catch. Market cap isn't what a company is truly worth. It's what the market is willing to pay right now. It's the scoreboard, not the final truth. Hope, hype, and fear are all priced in. Which is exactly why the next question is whether that price is actually justified. And that's where ratios like price to earnings come in. So, back to where we started. $10 stock, $500 stock. Which is bigger? Now you know the only honest answer. Check the cap, not the price tag. The share price is the cost of one bite. The market cap is the size of the whole meal. Confuse the two, and you'll spend your investing life thinking the cheap stocks are small and the pricey ones are giants. They're not. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.